Okay, so you should have now tried S5-10 on your own. If not, as I said before, just pause it, try it on your own, and then come back and check the solution after. So S5-10 says to journalize the following sales transactions for Salem Sportswear. Explanations are not required. So we are Salem Sportswear, and now we're the seller. We're looking at selling inventory. The first entry is on July 1st, and it says that Salem sold $20,000 of men's sportwear for cash. The cost of the goods sold was $10,000. So 2 entries, because we're using perpetual, we need to record the revenue side as well as adjust the inventory and cost of goods sold. So we'll start by recording the revenue side. So we debit, it says it was for cash. So debit cash, credit sales revenue. And it was sold for $20,000. But we also need to move these items out of inventory and into cost of goods sold. So the second entry here will be to debit cost of goods sold and credit inventory. We don't use that same amount that we sold them for. We need to use the cost of that inventory, which was $10,000. Okay. Then on July 3rd, Salem sold $62,000 of women's sportwear on account, and the credit terms are 3/10 and 30. Cost of these goods was $31,000. So we're going to do the same type of entry, only now we sold on account. So we'll debit accounts receivable instead of cash. Still credit our sales revenue. And we sold them for $62,000. But we also need to decrease our inventory, move it into cost of goods sold. So we debit cost of goods sold, credit inventory, and the cost was $31,000. Okay. Next, on July 5th, Salem received a $4,500 sales return on damaged goods from the customer from the July 1st sale. Cost of the goods damaged is $2,250 and money was refunded. So it's from this sale on July 1st. So that customer paid us cash. Therefore, now that they're returning something, we need to give them cash back. July 5th. First, it's a return, so we need to reduce the revenue, but we do this through the contra account. So we debit sales returns and allowances, goes into that account. But we're giving them money back, so we're going to credit cash because they actually have paid us for this already. This is for the $4,500. But since this customer is returning the goods, we're putting them back into inventory. So we also have the second part of the entry here. To debit inventory, credit cost of goods sold. These items are no longer sold, and the cost was $2,250. So that is the amount we put back into inventory. Okay, and then lastly, on July 10th, Salem receives payment for a customer on the amount due, less the discount. So that would be this sale that happened on July 3rd. Because it was the sale on account. And it says that it is less the discount, which we know they purchased it on the 3rd, and the terms were 3/10 net 30. So they had 10 days to pay to receive this discount. It is now July 10th, so they are in fact paying within that discount period. Therefore, we're going to collect that reduced amount. So we're collecting money, so we are going to get cash. We're also going to reduce our AR. But first, we need to figure out the discount amount. So the return that we had here on July 5th related to the sale on the 1st. That means there's been no returns or allowances to our July 3rd. So we still have the full AR of $62,000 outstanding. So we can go ahead and credit accounts receivable for that full amount, because they're never going to pay us anything else, so we get rid of the full AR amount. And we also use this $62,000 to figure out our discount. So we take $62,000, we can multiply that by this 3, that's the 3% discount. So if we do that math, it ends up $1,860 is the discount amount. So when we give a discount when we're the sale, again, we use this contra account. So we'll debit sales discounts. It's going to reduce our revenue, but we do it through the contra account. And therefore, the cash that we will get is the $62,000 minus that discount. So the net cash is $60,140. Okay, so that is a look at an example for sales.